ExamPrep.School. Alaska Life Insurance Producer Exam. Exam code OPLife01 or OPLife01. There are 4 practice exams in this series. This video covers Practice Exam 1. The first 20 questions are free. In this video, we will be covering the following major categories for Practice Exam 1. Alaska laws, rules, and regulations common to life, health, property, casualty, and personal lines. Alaska laws, rules, and regulations pertinent to life insurance only. Completing the application, underwriting, and delivering the policy. Life provisions, riders, options, and exclusions. Retirement and other insurance concepts. Types of policies. Let's walk through the format. I'll read each question and its choices. Let's get started. Question 1. Which pairing correctly matches the face amount and premium structures for level term and decreasing term life insurance policies during their initial level term period? A. Level term, level face amount, decreasing premiums. Decreasing term, decreasing face amount, level premiums. B. Level term, level face amount, level premiums. Decreasing term, decreasing face amount, level premiums. C. Level term, level face amount, level premiums. Decreasing term, level face amount, decreasing premiums. D. Level term, decreasing face amount, level premiums. Decreasing term, decreasing face amount, decreasing premiums. A countdown circle appears in the top right. Once it completes, the answer is revealed. You can pause at any time if you'd like longer to think. If you'd like additional practice covering more topics, see the description for our book. The correct answer is B. This option reflects that level term policies provide a constant death benefit with fixed premiums over the level term, while decreasing term policies reduce the face amount over time but maintain constant premiums throughout. Reason A is not correct. Premiums under level term remain constant and do not decrease, making this pairing incorrect. Reason C is not correct. Decreasing term policies reduce the death benefit, so the face amount cannot remain level under decreasing term coverage. Reason D is not correct. Neither type features a decreasing face amount for level term, and decreasing term does not have decreasing premiums. Question 2. Decreasing term life insurance, characterized by level premiums and a declining face amount, is most appropriately used to cover which of the following financial obligations? A. Estate tax liabilities expected at insured's death. B. A fixed-rate mortgage loan balance over its amortization period. C. Final medical and funeral expenses. D. Income replacement for dependents with ongoing needs. The correct answer is B. Decreasing term insurance aligns with obligations that decline in value over time, such as mortgage balances, by maintaining level premiums while the face amount decreases accordingly. Reason A is not correct. Estate tax liabilities do not typically decline over time, and thus are better covered by level benefit policies. Reason C is not correct. Medical and funeral expenses are lump sum obligations that do not decrease, making level term more suitable. Reason D is not correct. Income replacement requires a consistent benefit level for dependents rather than a declining face amount. Question 3. An agent is arranging a 10-year level term life policy combined with a decreasing term rider for a client's mortgage. Which disclosure and record-keeping requirement must the agent satisfy at the time of sale? A. File the coverage pattern disclosure with the state insurance department before policy delivery. B. Include the coverage pattern only in the policy summary without maintaining any record of delivery. C. Provide the insured with a schedule showing the guaranteed level and decreasing coverage amounts, and retain a copy of that disclosure for at least 3 years. D. Disclose the coverage patterns verbally at policy delivery and document confirmation in writing later. The correct answer is C. The correct answer is to provide the insured a written schedule of both level and decreasing coverage amounts at inception, and keep a copy of that disclosure for at least 3 years, as required by national regulations on term coverage patterns and record keeping. Reason A is not correct. Filing with the department is not required. Only delivery to the insured and agent retention are mandated. Reason B is not correct. Omitting record keeping contradicts the requirement to retain disclosure copies for regulatory review. Reason D is not correct. Verbal disclosure plus later documentation fails to ensure timely written notice and the 3-year retention requirement. Question 4. A producer misstates the decreasing term rider on a level term policy as providing a level death benefit. Under national rules for coverage patterns, which remedy is available to the applicant? A. Require the producer to remit a statutory penalty to the insurer. B. Maintain the policy and have the insurer pay the level benefit misrepresented. C. Receive no remedy if the error is deemed immaterial by the insurer. D. Rescind the policy within 30 days of delivery and receive a premium refund. The correct answer is D. The correct answer is that the applicant may rescind the policy within 30 days of delivery and obtain a full refund of any premiums paid, as required for misrepresentations of coverage patterns. Reason A is not correct. Producers do not pay statutory penalties to insurers for coverage pattern errors. Rescission is the remedy. Reason B is not correct. Insurers do not pay a benefit the policy does not provide. The remedy is rescission, not forced benefit payment. Reason C is not correct. Misrepresentation of benefit patterns is material and entitles the applicant to rescind. Question 5. A 15-year renewable term. Policy guarantees renewability without proof of insurability. At the first renewal when the insured is older, how may the insurer adjust the premium under national standards? A. Maintain the original level premium for the remainder of the term period. B. Increase the premium based on the insured's attained age schedule without requiring evidence of insurability. C. Require new evidence of insurability before renewing at any adjusted rate. D. Reduce the death benefit proportionally to offset higher renewal premiums. The correct answer is B. The correct answer is that a guaranteed renewable term policy allows premium increases at each renewal based on the insured's attained age schedule without requiring evidence of insurability as defined by the renewability clause. Reason A is not correct. Level premiums beyond the initial term contradict the guaranteed renewable provision. Reason C is not correct. Guaranteed renewability explicitly removes the need for new insurability evidence. Reason D is not correct. Death benefit reduction is not used to offset premium increases in renewability clauses. Question 6. An ordinary whole life insurance policy featuring a fixed premium structure obligates the policy owner to make level premium payments until which of the following events? A. Premium payments cease when the policy's cash value accumulation equals the death benefit. B. Premium payments remain level until the death of the insured or the policy's maturity age, often age 100. C. Premium payments cease after a predetermined limited payment period, after which the policy is paid up. D. A single lump sum premium is paid at policy issuance, eliminating future premium obligations. The correct answer is B. The correct answer is that ordinary whole life with fixed premiums maintains level premium payments until the insured's death, or the policy reaches its maturity age, commonly age 100. This differentiates it from limited payment policies, which stop premiums after a set period, and single premium policies, which are funded by one upfront payment. Reason A is not correct. This is incorrect because cash value equaling the death benefit describes an endowment feature, not the premium pattern of an ordinary whole life fixed premium policy. Reason C is not correct. This describes a limited payment variant, whereas ordinary whole life fixed premium policies require level payments for the policy's duration. Reason D is not correct. This describes a single premium whole life policy, not an ordinary whole life policy with level premiums over time. Question 7. After 3 years of paying level premiums on an ordinary whole life policy, the policyholder notices the cash surrender value is significantly lower than the total premiums paid. Which of the following best explains this discrepancy? A. The insurer amortizes acquisition expenses over the early policy years, reducing initial cash values. B. Mortality charges in the first years exceed the level premium deposit into cash value. C. Policy terms impose a waiting period before any cash value can accumulate. D. Dividends credited to the policy have been deferred and not yet added to cash value. The correct answer is A. The correct answer is that insurers recover upfront acquisition costs by amortizing expenses in the early years, which reduces the initial cash surrender values compared to cumulative premiums. Reason B is not correct. This explanation confuses mortality charges with expense loading. Mortality costs are reflected, but it's the front-end expense load that primarily depresses early cash value. Reason C is not correct. Cash values begin accumulating from the first premium. There is no waiting period in ordinary whole life policies. Reason D is not correct. Dividends are a non-guaranteed element and do not affect guaranteed cash surrender values in the early years. Question 8. An agent provides a prospective purchaser with a non-guaranteed illustration of a fixed premium whole life policy showing projected dividend scales. According to standard illustration requirements, what must the agent include alongside the projections? A. A clear statement that projected dividends and non-guaranteed elements are not guaranteed. B. A summary of the policy loan interest rates applicable under the policy. C. The insurer's current financial strength or solvency ratings. D. Information on the commission the agent will earn if the policy is sold. The correct answer is A. The correct answer is that illustrations must prominently disclose that any projected dividends or other non-guaranteed items are not guaranteed by the insurer to avoid misleading the purchaser. Reason B is not correct. Policy loan rates are governed by the contract and not a mandated component of the illustration disclosure. Reason C is not correct. Financial strength ratings are not required to be included in standard policy illustrations. Reason D is not correct. Agent commission information is not a required element in life insurance illustrations. Question 9. A policy owner wants to transfer complete ownership rights of a fixed premium, whole life policy to a lender as collateral for a loan. Which form of assignment should be used to ensure the lender holds all policy rights indefinitely? A. Collateral assignment. B. Irrevocable assignment. C. Absolute assignment. D. Conditional assignment. The correct answer is C. The correct answer is absolute assignment, which permanently transfers all policy ownership rights and incidents of ownership to the assignee without reservation. Reason A is not correct. That only pledges the policy as loan security while retaining ownership by the policy owner. Reason B is not correct. Making an assignment irrevocable affects rescission rights but does not itself fully transfer ownership. Reason D is not correct. Conditional assignment creates limitations based on conditions and does not guarantee full, indefinite transfer of all rights. Question 10. Which of the following best defines the quarter requirement in a universal life insurance policy? A. Mandates a minimum difference between the policy's death benefit and its accumulated cash value to maintain tax status. B. Requires the policyholder to pay a minimum premium within a specific quarter period after policy issuance. C. Limits the cash value growth rate to the prevailing interest rate credited by the insurer. D. Establishes a guaranteed maximum mortality charge based on the insured's age and sex. The correct answer is A. The correct answer is a requirement that the death benefit always exceeds the cash value by a specified minimum amount, so the policy meets IRS guidelines under Section 7702 and preserves its favorable tax treatment. Reason B is not correct. The corridor provision does not impose minimum premium payments. It governs the relationship between death benefit and cash value. Reason C is not correct. Growth rate constraints on cash value are determined by credited interest rates, not by corridor requirements. Reason D is not correct. Mortality charges are separate components of policy costs and are not set by corridor requirements. Question 11. A policy owner has a universal life policy with flexible premiums and opts to pay only the minimum required to satisfy corridor requirements. At the policy's 5th anniversary, the insurer's corridor test reveals the cash value falls below the required percentage. What action will the insurer most likely take? A. Notify the owner of the corridor deficiency and require a premium payment to restore the minimum corridor. B. Automatically lapse the policy for failure to meet required funding levels. C. Increase the cost of insurance rates to maintain the existing death benefit. D. Convert the policy to a term life policy to eliminate the corridor requirement. The correct answer is A. The correct answer is to notify the owner of the corridor deficiency and require payment to restore the minimum corridor, because the insurer must ensure that the policy's cash value meets the regulatory corridor test before continuing coverage. Reason B is not correct. Automatically lapsing the policy is incorrect, since insurers must first notify the owner and allow corrective payment rather than lapse immediately. Reason C is not correct. Increasing cost of insurance rates does not address the regulatory corridor requirement, which is based on cash value percentage, not COI charges. Reason D is not correct. Converting to term is incorrect because the insurer cannot unilaterally convert a permanent policy to term to satisfy corridor rules. Question 12. An agent issues a universal life policy and prepares the required policy illustration. Under NAIC model regulation requirements for universal life flexible premiums, when must the insurer deliver the illustration to the policy owner? A. At or prior to policy delivery. B. Within 30 days after the policy is in force. C. At application for admission to coverage. D. Within 15 days of any change in assumed interest rates. The correct answer is A. The correct answer is at or prior to policy delivery because NAIC model regulation mandates that the policy illustration must be provided to the owner no later than the time the policy is delivered. Reason B is not correct. Delivery within 30 days after in-force date is incorrect since regulations require earlier delivery at the point of delivery. Reason C is not correct. Providing the illustration at application is incorrect because the model requires delivery at policy delivery, not necessarily at application. Reason D is not correct. Delivery within 15 days of rate changes is incorrect as the regulation does not specify this timing for the initial illustration. Question 13. A universal life policy owner requests a decrease in the death benefit from $500,000 to $300,000. The policy's cash value is $50,000. After the adjustment, what effect will this have on the insurer's corridor requirement and funding adequacy? A. The minimum corridor requirement decreases and no additional premium is needed. B. The insurer recalculates the corridor but requires a corrective premium payment. C. The reduction triggers a modified endowment contract (MEC) test before adjustment. D. The insurer increases the guaranteed interest rate to offset the lower death benefit. The correct answer is A. The correct answer is that the minimum corridor requirement decreases, and no additional premium is needed because reducing the death benefit lowers the required corridor percentage, so existing cash value remains sufficient. Reason B is not correct. Requiring corrective payment is incorrect, since the corridor minimum falls with the death benefit. Preserving adequacy without extra premium. Reason C is not correct. A MEC test is incorrect because death benefit reductions do not automatically trigger MEC testing under flexible premium UL. Reason D is not correct. Increasing the interest rate is incorrect as interest rate adjustments are unrelated to death benefit changes and corridor rules. Question 14. Which of the following best distinguishes an immediate annuity from a deferred annuity? A. Income payments begin within 1 year of purchase. B. It typically uses periodic premiums paid over an accumulation period. C. It cannot be funded via a single lump sum payment. D. It offers a cash value accumulation phase before income distributions. The correct answer is A. An immediate annuity begins its income payment phase shortly after purchase, typically within 12 months, whereas a deferred annuity delays payouts until after an accumulation period. Reason B is not correct. Periodic premium payments over an accumulation period describe a deferred annuity, not an immediate annuity. Reason C is not correct. Immediate annuities are generally purchased with a single lump sum payment, so stating they cannot be funded that way is incorrect. Reason D is not correct. A cash value accumulation phase is a feature of deferred annuities, not immediate annuities. Question 15. Which client objective would most likely make the purchase of a deferred annuity more suitable than an immediate annuity? A. To accumulate earnings on a tax-deferred basis until retirement. B. To begin receiving predictable income payments within 1 month of purchase. C. To ensure a one-time lump sum death benefit for beneficiaries. D. To lock in a fixed income rate upon annuity issuance. The correct answer is A. Deferred annuities are designed to provide an accumulation phase with tax-deferred growth before income payouts, making them suitable for clients focused on growing assets until retirement. Reason B is not correct. Receiving income within 1 month is characteristic of an immediate annuity rather than a deferred annuity. Reason C is not correct. A one-time lump sum death benefit does not align with the primary objective of accumulating tax-deferred earnings. Reason D is not correct. Locking in an income rate at issuance is a feature common to both annuity types and does not specifically favor deferred annuitization. Question 16. An annuity producer is presenting a deferred fixed annuity illustration to a client. Under the NAIC Suitability in Annuity Transactions Model Regulation, which element must be included in the disclosure illustration? A. A narrative description of all optional rider fees. B. A projection of accumulation value at the maximum credited rate for at least 20 years. C. Separate pages showing guaranteed and current non-guaranteed interest components. D. A detailed amortization schedule of surrender charges. The correct answer is C. This option is correct because the regulation mandates a separate presentation of guaranteed and non-guaranteed values to prevent consumer misunderstanding of projected returns. Reason A is not correct. A narrative of rider fees is not specified by the NAIC model regulation for deferred annuity illustrations. Reason B is not correct. A long-term maximum rate projection is not required and may mislead consumers about realistic earnings. Reason D is not correct. A surrender charge amortization schedule is not a mandated illustration element under the NAIC model. Question 17. A 65-year-old client has held a deferred fixed annuity and plans to annuitize immediately. If the client elects instead to defer the start of payments for an additional 3 years, how will her periodic income payments most likely change? A. Payments will decrease because the insurer applies a deferral penalty. B. Payments will remain unchanged since the contract rate is fixed. C. Payments will increase due to additional interest accumulation. D. Payments will decrease because of shorter remaining life expectancy. The correct answer is C. This option is correct because deferring annuitization allows the accumulation of additional interest, increasing the contract value used to calculate higher future income. Reason A is not correct. There is no deferral penalty in a fixed annuity. Growth rather than penalties applies during the accumulation period. Reason B is not correct. A fixed rate applies to accumulation, but delaying start allows more accumulation, so payments change. Reason D is not correct. Life expectancy assumptions apply at annuitization, but deferral increases value, offsetting shorter payment period. Question 18. Which of the following items is not expressly incorporated by the entire contract clause in a life insurance policy? A. The policy documents provisions. B. The original application and any riders. C. Insurers' advertising and sales materials used in soliciting the policy. D. Amendments and endorsements attached to the policy. The correct answer is C. The entire contract clause binds only the policy document, the original application, and any attached riders or endorsements. Advertising and sales materials are not part of the contract. Reason A is not correct. The policy's provisions are the core of the entire contract clause and are included. Reason B is not correct. The original application and riders are explicitly stated as part of the contract. Reason D is not correct. Amendments and endorsements attached at issuance are incorporated by the clause. Question 19 regarding claim settlement. Which statement best reflects the effect of the entire contract clause in a life insurance policy? A. Misstatements on the application cannot be used to contest a claim after policy issuance. B. Provisions in the application take precedence over policy terms when there is a conflict. C. Sales brochures and advertising materials are considered part of the contract and may influence claim outcomes. D. The application, when attached, forms part of the contract and may be used to verify applicant statements at claim time. The correct answer is D. When the application is physically attached to the policy, it becomes part of the contract. Any statements within it may be used to validate or contest information during claim settlement. Reason A is not correct. Misstatements can be used because the application is part of the contract when attached. Reason B is not correct. The policy terms control and the application does not override them in conflicts. Reason C is not correct. Advertising materials are not incorporated into the contract and have no bearing on claim decisions. Question 20. After issuance of a life policy accompanied by a term rider, the producer delivers the policy to the policy owner. According to the entire contract clause, which documents must be provided at delivery? A. The policy and a copy of the application. Or B. The policy, the original application, and the term rider. C. The policy, the term rider, and a waiver of premiums. D. The policy and a statement of the insured's health. The correct answer is B. The entire contract clause specifies that the policy, the application, and all riders form the contract. Thus, the term rider must accompany the original application and policy. Reason A is not correct. This choice omits the term rider, which is required as part of the contract under the entire contract clause. Reason C is not correct. A waiver of premiums is not a mandatory contract component under the entire contract clause. Reason D is not correct. A statement of health is not included among the required contract components defined by the entire contract clause. Enjoyed this practice test? Tap like, hit subscribe, and share it with a classmate. Got a question we should tweak? Comment below, we read them all. Find full practice exam books in the description or at ExamPrep.School.